If you look at the fundamentals, this is BTC USD and the software ETF. Like this is Bitcoin and software. They're still directly correlated. So Bitcoin popped because software popped. If Bitcoin was starting to move against other things in a really strong way, now we'd be talking. And it's shown a little bit of life there, but not enough for me. So that's why I'm just saying, just be careful, guys. Be really careful. Because if it comes out that this war is going to go all the way until the winter, that oil is going to hit 200, and that Trump and this administration has engaged in very serious high-stakes poker, and it's not really clear how this is going to end, things could sell off in a major way, in a major way.
Bitcoin may be rallying in the short term, but according to Strike CEO Jack Mallers, investors should not confuse a temporary bounce with a true shift in market fundamentals. In a recent interview, Mallers points out something many traders are overlooking right now. Bitcoin's price action remains closely tied to traditional risk assets such as software stocks. In other words, the recent move higher may not be driven by Bitcoin itself. It may simply be moving with the broader tech market. And that matters because the macro environment right now is incredibly fragile. Rising geopolitical tensions, surging oil prices, and an increasingly unstable global financial system are creating the kind of volatility that can shake markets across the board, including crypto. Mallers warns that if the current geopolitical conflict drags on and oil prices spike toward $200, we could see a major risk-off event where assets across the market sell off sharply. But here's the bigger question investors are asking. If that volatility does happen, could it actually create one of the best Bitcoin buying opportunities in years? Because despite all the uncertainty in the short term, the structural problems inside the global financial system are getting worse. And those problems may ultimately be the exact forces that drive Bitcoin to new highs in the long run. In this video, we break down why Mallers believes the financial system is approaching a breaking point, and why Bitcoin could massively benefit from it. Please watch, share, and like this video, subscribe to the channel, and drop your comments and observations in the comments section below. These actions cost you nothing but help us immensely, so we may continue to bring you these videos. Thanks for your support, and let's dive right in.
So more on the fiscal math. So we're not quite at 40 trillion. We're at $38.8 trillion of federal debt. Our debt to GDP is well over 100%, sitting at a mere 122%. And our deficit to GDP is 6%. That's insane, guys. Meanwhile, over the weekend, Trump said he may need to lift the military budget from $1 trillion a year to $1.5 trillion. So the spending can't stop. And this is why I've said the only way I see out of this is some form of yield curve control. Where yield curve control, for those that don't know, is if the United States can't find buyers of its bonds. Again, buyers of its bonds are just lenders. When I buy a bond, I'm lending money to the U.S. government, and the yield I'm getting is the interest they're paying. If there's no more buyers of U.S. bonds, then what happens is the Federal Reserve just prints money and lends it to the U.S. and buys the bonds. And that's called yield curve control because you are controlling the yield. You are capping the yield. You are saying the yield cannot go to 5 or to 6 or to 7 because the U.S. can't afford it. So if there isn't enough demand, the Federal Reserve will print the difference and make the demand. That is the end game. That's just literally you're printing money to borrow money in a perpetual loop. That's the sovereign debt crisis. That's it. That's GG's. That's good game. Tip your king, resign. And that's where you get a more serious version of defaulting via inflation. Because the amount of dollars that are going to need to be printed to sustain these level of deficits, this level of military budget is immense. You are going to get direct inflationary forces to the face. And that's where you see something like Bitcoin and gold. These things are going to screech. Like people talk about God candles, Bitcoin going up $100,000 in a day. It would be on days like that, like announcing yield curve control programs. And that's the only way I see this. That's why you stay humble, you stack sats, you turn on your DCAs right now. It could get a lot uglier in the near term. If oil does go to 200, if Trump really tries to push this, and risk can sell off violently. But over the medium to long term, there's no way out. They have to print the money. And like, this is only expediting the reality. So I found this tweet from Peruvian Bull. I've listened to him on Marty's show a few times. Really good insights. I like his stuff. So he kind of described this Japanese doom loop. So he says, Japan can't absorb this. Every dollar higher in crude oil is a direct tax on their entire economy. Energy costs spike, import bills explode, the trade deficit widens, and the yen weakens further, which makes the energy imports even more expensive. So you guys see how this is kind of like a loop. It's a doom loop. Weak yen makes oil more expensive in yen terms, which worsens the trade deficit, which makes the yen weaken further, which makes the oil more expensive, which worsens the deficit, which weakens the yen, goes on. If oil stays above $90 and the strait stays shut, the Bank of Japan has to choose between defending the yen, which is hiking rates, blowing up the JGB market and the carry trade, or letting it crash. And so again, guys, it's all one giant Ponzi scheme of dominoes. If Japan can't sustain this, by de facto, the U.S. can't sustain this. Because guess what? When Japan starts to face the heat, what do they sell? They sell U.S. stocks. They sell U.S. treasuries. They sell U.S. treasuries. What goes up? When bond demand falls, yields go up. Yield goes up. What goes up? U.S. interest payments. It's all one connected tissue of Ponzi. So when people do not appreciate, when Trump says, I can sustain this pain, it doesn't matter what you can do. It's what can the fiat system sustain. This immoral, unethical, giant Ponzi scheme that's been created over the last decades. So what's the collateral damage? Foreign holders need dollars, so they're selling everything to get the dollars. Look at this last night. South Korea's Kospi falls more than 6%. Japan's Nikkei falls over 5.5%. This is not a drill, guys. What I'm saying is not theory. It's facts. It's facts. No bueno. Not good. And weirdly, everyone in markets is starting to draw echoes of 2008. So first and foremost, BlackRock limited withdrawals from one of its flagship private credit funds. That's bad. More stress in the private credit market. And it's not from names you've never heard of. It's from BlackRock. That is not good. On top of that, Joe from Bloomberg and Kelly from CNBC both wrote independent newsletters that this macro environment is giving them flashbacks to 2008. High oil prices, bad job prints, stressed liquidity. Not good. Not good. On top of that, this is a central banker's worst nightmare, because in the midst of all of this, while all of this is going on, the change in non-farm payrolls missed by a long mile. The expectation was 55K and it got negative 92K. And so it's a central banker's worst nightmare. Why? Well, on one end, you have inflation coming because oil price is surging, energy is surging, and everyone's eggs, housing, everything is going to get more expensive if this keeps up. On the other hand, you have job destruction and deflationary pressures. Payrolls are crashing. People are going to be left unemployed. So how do you fight the AI deflationary pressure? You print money. How do you fight oil surging and the inflationary pressure? You hike interest rates. Pick one. It's a lose-lose situation. Again, guys, we've reached the end of the road.
What Mallers is describing here goes far beyond a typical market cycle. The real issue lies in the math of the global financial system itself, with U.S. federal debt now approaching $40 trillion, debt to GDP well above 100%, and persistent government deficits continuing year after year. The system is increasingly dependent on one thing: the continued ability of governments to borrow cheaply. But that assumption is starting to crack. As Mallers explains, if global investors stop buying enough U.S. government bonds, the Federal Reserve may be forced to step in and print money to buy those bonds itself. That policy is known as yield curve control, and it essentially means the central bank artificially caps interest rates by creating new money to absorb government debt. It's a mechanism that has been used before in countries like Japan, but applying it in the United States would represent a dramatic shift in monetary policy. And that's where the bigger macro chain reaction begins to emerge. rising energy prices, weakening currencies in major economies, and the possibility of central banks being forced to print even more money all create pressure throughout the global financial system. If foreign governments or institutions begin selling U.S. treasuries to raise cash, as Mallers points out, bond yields rise, government borrowing costs increase, and the debt spiral accelerates. This is why analysts are starting to see uncomfortable parallels to past financial crises. Liquidity stress in markets, weakness in global equities, and early signs of strain in private credit are all signals that the system may be entering a more unstable phase. And if that instability spreads, the assets designed to hedge against monetary debasement, like gold and Bitcoin, could eventually become the biggest beneficiaries.
So the question in this giant chess game that we're playing, as Luke very eloquently points out, both in his newsletter and on Twitter, is who breaks first? The game between the US and Iran/Russia/China, so the West versus the East, the game is who breaks first. So this tweet from Luke here on the right, US and Israel are claiming that Iran is out of missiles with warheads lighter than 1 ton. Iran is claiming that Israel is out of interceptor missiles. So Luke writes, high stakes poker to find out who has been bluffing about missile capabilities and who hasn't. I'm not going to lie. I'm nervous. Yes, we're the United States. Yes, we're the greatest country in the world. Yes, we're the land of the free. But we have hollowed out our industrial base over the decades. Trump just had all the war defense companies come talk to him and say, you better produce as fast as you possibly can. And their reaction was, the only way we can do that is getting quicker shipment in from China. We don't have rare earths here. We can't produce shit without reliance on other people. So I'm a little nervous that we're in a game of poker right now of who's bluffing harder, who actually can produce interceptors and missiles, because I don't think the West wants that smoke. I don't think we want that beef. So this is Luke's most likely order of events on the left. He thinks the U.S. Treasury market will dysfunction first. The U.S. will run out of interceptor missiles first. Israel and the U.S. military assets are going to get crushed. And China and Iran will actually outlast this. The question is, can China hold its ground in regards to oil? Like, does it have enough and sufficient access to oil and oil inventory? And can Iran continue to produce weaponry and not run out of missiles? And can they do that before or after the U.S. Treasury market dysfunctions and the U.S. runs out of production? That's the game of poker we're in. Now, again, why we are in this, I don't know. I'm not in the situation room. I'm not briefed on why the we decided to do this. I'll get into it in Grind My Gears. I'm going to go off in Grind My Gears on this very topic, so I'll save it for that. But it doesn't make any sense to me, and I'm not going to lie, it's slightly concerning. I mean, to see Scott Bessent unsanctioned Russian oil is like, wow. That is, I mean, shit must be real bad. And we've heard people, there's suspicions that China is basically building gold-backed currency. And we know that the U.S. is working on, stable coins. This is just me speculating. I expect Bitcoin to become more of a geopolitical tool soon. I really do. There was something from the U.S. Treasury. Look at this, guys. So this is new. The United States Department of the Treasury admits crypto mixers have legitimate privacy uses on public blockchains, basically advocating for privacy technology for Bitcoin. Why would they do that? When you read a lot of the research from the government on Bitcoin and you hear people like Ray Dalio talk, one of the critiques is that Bitcoin actually isn't private enough for nation states. Like, no one truly knows how China's using gold and how much they have because there's no blockchain. And so one of the critiques is like people are able to track. Now, for us savvy Bitcoiners, we know how to use Bitcoin privately. We know how to use the Lightning Network. The U.S. government hasn't gotten that far yet. But to see them say, wait, privacy Bitcoin is actually a good thing. I've kind of described this in the past. My best guess at how the world evolves is that China is going to go gold and go heavy CCP. obviously. And the West is going to fall back on the internet. What is the internet? The internet is AI, social media, and Bitcoin. The internet's money is Bitcoin. The internet's monetary policy is Bitcoin. The internet's intelligence is AI. And the internet's networking is social media. And you'll have these two worlds fight each other. And one is distributed and fair and equitable and moral. And the other is more authoritarian and analog. And I think those are the two frontiers that the world will battle for the decades to come. I wanted to just make this slide called Not So Fast. When I made this slide, Bitcoin was rallying a lot. Like Bitcoin was up like 10% in a day. And everyone was like, let's go, bear market's over. It might be. I don't know. Okay, listen, I don't know. What I've been saying is turn on your DCAs. It's not going to get much lower for much longer than this. You're not going to regret this price in a few years. Turn on your DCAs, but it could. And if you look at the fundamentals, this is BTC USD and the software ETF. Like this is Bitcoin and software. They're still directly correlated. So Bitcoin popped because software popped. If Bitcoin was starting to move against other things in a really strong way, now we'd be talking. And it's shown a little bit of life there, but not enough for me. So that's why I'm just saying, just be careful, guys. Be really careful. Because if it comes out that this war is going to go all the way until the winter, that oil is going to hit 200, and that Trump and this administration has engaged in very serious high-stakes poker, and it's not really clear how this is going to end, things could sell off in a major way. In a major, major way. It might not. I don't know, right? Who am I? I have no idea. But just be careful, okay? Be careful.
If geopolitical tensions escalate and energy prices surge, markets could shift rapidly into a risk-off environment. In those moments, liquidity becomes king. Investors sell what they can, including stocks, tech assets, and sometimes even Bitcoin, to raise cash. That's why Mallers urges caution right now. Not because Bitcoin's future is uncertain, but because volatility could create sharp moves before the larger trend resumes. And while those macro risks are playing out, another battle continues to rage on behind the scenes between Wall Street, regulators, and the crypto industry. Major banking giants, including JP Morgan Chase, Goldman Sachs, and Citigroup, are now reportedly considering legal action against regulators over new rules that would allow crypto companies to operate across the United States with federal trust bank licenses. Institutions like Circle, Ripple, and Crypto.com could potentially offer financial services nationwide without facing the same regulatory structure that traditional banks operate under. From the bank's perspective, this creates what they call a shadow banking loophole, where crypto firms could hold digital assets, move money, and serve customers without the heavy compliance burden imposed on legacy financial institutions. But from the crypto industry's perspective, this conflict reveals something much deeper. It shows just how disruptive this technology has become, because for the first time in decades, the traditional banking system is facing real competition, not from another bank, but from an entirely new financial infrastructure built on blockchain networks and decentralized assets. And when you step back and connect all the dots, the exploding government debt, the growing possibility of monetary intervention, the instability in global markets, and the increasing tension between banks and crypto, it becomes clear why long-term investors continue to accumulate Bitcoin even during periods of uncertainty. Short-term volatility may still lie ahead. Markets could swing violently if macro conditions deteriorate. But the underlying forces driving Bitcoin adoption, from institutional demand to structural problems in the global financial system, haven't disappeared. In fact, many analysts believe they are becoming stronger. Which brings us back to the question at the heart of this discussion. Is this a good time to buy Bitcoin? If Mallers and other macro thinkers are right, moments of uncertainty like this may not represent the end of the cycle, but the exact windows where long-term opportunities appear. And now I want to hear from you. Do you think Bitcoin could still see a deeper correction before the next major rally? Or are we already witnessing the early stages of the next big move? Let me know your thoughts in the comments below. And if you found this breakdown helpful, make sure to like the video, subscribe to the channel, and turn on notifications so you don't miss the next deep dive into the forces shaping the global economy and the future of Bitcoin. Thanks for watching, and see you in the next one.